Hey everyone, it is Evan here from the Trade Risk on Wednesday, September 4th, here with video number 5 in our series on long-term market technicals. This is where we pull out the monthly charts, we take a step back, and we really try and get a handle and sense of the big picture globally across asset classes, stock markets, interest rates, commodities, really try and get a sense of where the trends are or lack thereof, and help us sort of give us some context and pull ourselves out from the day-to-day and week-to-week weeds of price action and really just get a sense of what the bigger picture structure looks like. This is video number 5. We started this series earlier at the start of this year, so we try and do these about every other month is about the timing of what we've been doing, and I think that's a good timeline for a very long-term picture and analysis looking at monthly charts like this. They don't change all that often, but I do think that this video at this point in time is particularly useful because we've just gone through a very, certainly news-heavy August that has been very pessimistic. Markets have been volatile, and we've seen a lot of choppy back and forth kind of wear you out behavior. And I think taking a step back, looking at the big picture, this is where you can really get some context, clarity, and help inform those shorter term trading decisions that we're making on a day-to-day, week-to-week basis. So we're going to run through charts here today. Reminder that these are monthly time frame charts. We are looking at indexes where possible. We're looking at either index data or futures rolling contracts. Any of the ETFs are all total return data, and that means that they include dividends, and all of these charts are logarithmic. So let us jump into the first here, which is the Dow Jones. And we can see that the Dow has been in this consolidation here for, see if we can edit this and annotate. Actually, we're going to close that out, and we'll actually keep it like this for now. So what we can see here with the Dow is that since the start of 2018, we have consistently bumped our head around this 27,000 level. We briefly broke out of it 2 months ago, or at least attempted to, and then we quickly kind of rejected back into this range. So what we find ourselves in is this holding pattern where we have this flat resistance coming in just under or around 27,000, and we have this long-term trend line that has been in place since really 2010, 2009. It dates all the way back. Matches up nicely here with the sell-off we saw in 2015, and then we tested this back in the middle of 2018 as well. But that is still in place. That is still holding. We have these series of higher lows. We have this flat top resistance, and as noisy and as choppy and as turbulent as it's been in these recent weeks or month of August, it really hasn't changed the price structure here whatsoever. We did attempt to break out just 2 months ago. That attempt failed. We came back into this range, and we're kind of waiting here in limbo for a resolve of either the flat resistance that we see here, or if we do start to accelerate lower, then it can get real nasty if we start to break down from this very long-term trend line that has been in place. So we're kind of wedging up here. We're getting tight. We got, again, a rising trend line, flat resistance, and over the next month or two, we're going to be looking to see if this can start to resolve one way or the other. It's been 2 years in the making, or just about that time. So the Dow Jones, that's the pattern that we're looking at here. We're in this period of noise on a monthly time frame, and we're looking to see if we can get a breakout here in coming days, not days, but in coming months. So 27,000 on the upside, new highs effectively. On the trend line here, you can watch recent lows of last month, or again, this trend line that has been in place. If we scroll down and we continue to take a look at some of the other U.S. sectors here, we look at the S&P 500. We do have slightly higher highs that we've been attempting to make here since the start of 2018. So in other other words, the Dow Jones has really sort of leveled off sideways, whereas the S&P has made this series of pushes that have got just barely incrementally higher since 2018. It topped out up here, it pulled back, it made a slightly higher high, it pulled back, and then we slightly made another higher high, and it's pulling back once again. So the pattern, the structure here, still pretty much similar and in place. We've gone not so far, you know, we haven't really moved too much directionally for the past year and a half, 2 years, and we've, you know, just tried to essentially you know, climb a little bit more incrementally to the upside here versus the Dow. But I think the structure here remains pretty much the same. Longer term trend line here, we have this more accelerated one that comes from the 2015 up to recent price levels. There's a lot of gap and air in here. We're at the upper end of the range effectively, and basically waiting to see if we can start to punch through, break out, and start to trend more cleanly like we saw back in, say, 2012 or even 2017. So we're still in this period of noise, as consolidation. And once again, we're kind of in that breakout mode waiting to see what happens. Now, if we scroll down here and look at the composite, so we're looking at the Nasdaq composite here again, you can see long-term trend has been in place since 2010. We tested it back in late 2018, and we are now to the upper end of the range. We did recently, again, attempt to break out to new highs. This too pulled back here and started to, let me zoom in a little bit more, and started to actually come back into this range. So we're still kind of waiting here again, all of these telling the same story of really a long-term picture here of mostly sideways consolidation with a slight tilt to the upside in most of the major US averages. But here's the thing, we again still haven't entered into a clean sort of uptrend phase like we've seen in 2013, 2016, 2017. It's been a lot more volatile and sideways over the past period. Now the Russell 2000, if we scroll down here, you can see this one very much is diverging here from the other major averages. So the Dow Jones, the S&P, the composite, you could all say look pretty similar, correlation pretty high over the recent year or two. When we look here at the Russell, we do still have the long-term trend line that has been in place since the 2011 lows here, and you can see we have tested it multiple times, again recently in 2018, but you can see we are much closer to the lower end of this range, and in fact getting close to kind of this rising trend line again, and we have this stiff kind of flat sideways resistance here in the middle of this upward sloping channel, or maybe a tightening wedge here around the 1600 level. So the Russell 2000 small cap stocks have definitely felt some of the underperformance. They're still up on the year, but certainly from a price structure basis, small caps are lagging here, and we do want to at least pay attention to that. We want to pay attention to this rising trend line here, and ultimately that 1600 level, that's where sellers have been repeatedly showing up. So if we can start to punch through there, that's when the story starts to change, and maybe this gets a rotational favor and can start to help to lead the overall US averages to new trending highs. But until and if we start to see a little bit of a change of character here, some catch up, take out resistance, again at those 4, 5, 6 month cluster of highs there, we do want to be a little more at least cautious here, or less excited about the Russell 2000 when you have things like the Nasdaq that's trying to break to new highs, S&P and Dow as well. So that's the big picture there. We're back to the lower end of this range here. This is where buyers have repeatedly showed up, so we'll see if they do it again. Again, reward to risk, your levels are clear here. That is the positive thing. You just may have to wait for some chop if you're starting to take positions here or allocate to play some catch up for the Russell 2000. Now, if we scroll down and we start to look at some breadth information here and breadth statistics, we look here at the NYSE advanced decline line. This is the cumulative reading, and what we can see here is that this is showing actually some quite bullish behavior here, as this is ratcheting up and continuing to trend up at new all-time highs. This is something that is, again, very bullish underpinning for the market overall. When we have this leading to the upside, this basically is telling us that the liquidity here is still strong. There's still plenty of stocks that are advancing here on a net basis, and that it's not just a large cap scenario or phenomenon that's leading this market, we actually do still have, even though despite what the Russell 2000 looks like here, we are still getting the AD line, which is trending to new highs here. So unlike, the S&P, the Dow, the Qs, and the Russell, which still haven't broken out and started to trend to new highs, when we look back here, again, we just have the nice smooth uptrend that is in favor. So this here is bullish underpinning here for the U.S. markets. It does sort of suggest or tilt or kind of increase those odds that maybe the breakout resolve does happen to the upside. Of course, this isn't a reason alone to make that decision, but it certainly does help when we start to take a sort of weight of the evidence approach. The other thing that's constructive here is the new 52-week highs list. So again, a measure of breadth. We're looking at the new 52-week highs minus the new 52-week lows. So we're basically just looking at the net effect here of what's happening on terms of 52-week highs minus lows. And what we can see here is that even though the month of August has been very choppy and we did get some briefly negative readings here, we are still mostly probing back up here and are in the kind of healthy to mildly to moderately healthy environment here. Obviously back in, again, the strongly trending environments, you like to see readings up here more consistent above 200, 250 when you're in that nice strongly trending phase, or when you're about to start or enter a new trending phase. You like to see nice thrusts higher here and see lots of stocks hitting new 52-week highs. So we don't quite have the extreme strength, but we certainly are on the right side of the fence here if you're in the bull camp, because we are, hanging out here and working on the upper end or positive note here. More stocks are reaching 52-week highs than they are 52-week lows. And again, when we think about just the underlying health and what that says about the market, that does give us more sort of confidence or evidence that this market does favor the bulls here in this long-term picture as they consolidate sideways in the major U.S. indices. Now, if we scroll down here, we take a look at volatility. Really, I like to throw this on here just to take a snapshot of where we are compared to the historic average. So if we look at just, say, a 10-month simple moving average here, which is approximately about a 200-day moving average, you can see it's a 16.98 is about the average volatility that we see in the stock market over time. We're trading above that. So again, that shows us that there's some fear out there. There's a little bit of uncertainty, at least, that people are buying protection and that the market is, sort of out there worrying about something. And certainly, as we spoke about at the top of at the top of this video, August has given us plenty to worry about in terms of recession, yield curve inversion, tariffs, everything else that you could think of to worry about. And we can see we are trading above our historic average of volatility. Now, the next chart here is the US dollar. This is the cash settled index. This year, I don't really have any other new insightful comments except for the fact that we continue to grind higher here. So the bull market in the dollar is still just up and to the right, moving here back up towards the 2016, 2017 levels. Again, it has been sort of mostly range bound here, but it has been working itself higher. We don't really see that stopping as of right now. It looks like it wants to kind of still climb up here to perhaps this $100 area where it's been in the past. So USD continues to move higher, but again, no real other new technical insight there. Now, in terms of credit or junk bonds here, looking at high yield credit, this here does still, again, suggest the fact that we are back up here at new highs ahead of the market. Kind of keep this in sort of the breadth indicator, if you will, just to give us some evidence behind the scenes. And this is basically telling us that, even the high yield market, the credit market, is still saying and suggesting that liquidity is strong right now. We're trading at all-time highs, or just about. Again, this is a total return chart, so I do understand that this does include all of the high yield that this throws off every month, but it is still moving up here and trending to the right. Good volume coming in recently, and again, if we were to see more of a divergence here, if you saw this flatlining or going down, that is where you want to get concerned, or you start to poke your head up and flash some warning signs when credit starts starts to go the other direction. But right now it continues to push higher here. So that gives us, again, some bullish underpinnings there for the U.S. market. Now, when we get down to the world market here, so the MSWORLD index is what we're looking at now, and this is basically the world minus the United States, minus the U.S. So this is looking at the world equity markets minus the U.S. You can see this definitely is not as rosy of a picture as the S&P, the Nasdaq, or the Dow Jones. This here is still kind of hanging out at the bottom end of this channel here that it's been in since 2011. It's still holding that that trend line, this trend line here that's extending on the lows, and it is kind of floating here in the middle of this space here, which doesn't give us a whole lot of price structure to latch on to, but it is not quite at these highs like the U.S. markets are. So there's still some lagging, some underperformance here from the world. Again, it is still potentially holding up, and I think the ideal situation here is that it puts in some type of higher low. Basically, what I would like to see here if you're a bull is that you don't want to see this come, slamming back down into this lower trend line to retest the 2018 lows. You want to see this really try and hold in above 1800 or so, and if it can hold in above 1800, put in some type of higher low and then start to work higher back into this range, back to the upper end of this channel. That's the ideal situation there in terms of how this develops over the next coming months. But again, we'll have to take this one day at a time, or 1 month at a time, I guess, in this picture here, because it is still underperforming, and the U.S. market is still flexing its dominance here in terms of return and capital appreciation. Now, if we go to the next chart here, we look at a similar picture, and this is emerging markets. So emerging markets had a pretty good pattern here, price structure going for it. I mean, we had this pullback into this long-term range, a bit of a retest breakout, a retest to the breakout that we saw in 2017. Fortunately, this has gotten a little bit sloppy here. Again, it's very similar comments. The way I look at this it's very similar to the world is we essentially want to try and see a higher low get put in here. We really want to see this back above $41. We want to see this holding above this prior breakout, but we especially don't want to see this come slamming back down against 38 or the lows that we made back in here in 2018. We want to see some type of higher low get put in, get above $41, and start to continue to trend to the upside here. So that would be the bullish development. If we continue to slide lower here, then of course, again, there's just better places to be as illustrated by these charts, and that's still U.S. markets here versus emerging or even the world at that rate. Now, the next market here is TLT. TLT here has been all the rage recently. We've seen just a total surge there. We've seen yields basically all-time lows right across the spectrum, and the TLT chart here really depicts just the total rush and relocation into an acceleration to the upside here. On this chart, it has really gone quite vertical here since the start of this year, basically going from 110 to 147 in a year's time, less than a year's time, is quite an extraordinary move for bonds. This isn't a small cap high tech growth name. This is the 20 plus year Treasury ETF. So this here is quite the move, and by most historic measures is quite extended here to the upside. Haven't quite seen a move as aggressive as this in quite some time. So in the short term, probably overdone for the next couple of months. I would not expect strong returns there, but momentum is a hell of a thing, and momentum can lead to higher prices as the chase is on. So this is something where, you just have to know what you're looking for. In fact, we did just initiate on a very short-term basis. This is a monthly chart, and we're playing for a very tactical multi-day to potentially a week or two hold a short position here in TLT. Again, it's very counter-trend to what we're seeing here. This is a much more shorter-term tactical trade that we have on, and definitely is not something we're looking to overstay our welcome or get stubborn in, because again, the trend here is very strongly to the upside on a longer term basis. We're just playing for a little mean reversion in the short term. So TLT, lots of strength there, and gold as well. This is really the big story here, because if you watch the earlier videos that we did on these long-term market technicals, we talked about, and we were still in this holding pattern here back in the beginning of this year, and we've really seen gold start to break out and ignite to the upside. We saw a tremendous amount of volume start to pour in here as this moved above 1350 and started to break out above multi-year highs, and this breakout here is still very significant. Once again, kind of like the TLT, this is very extended in the short term. Over the next days, weeks, this is still quite extended, but price structure here longer term looks quite good. We basically are emerging from a 6-year base that we've gone absolutely nowhere under this 1350 level. So essentially, if you are not looking to chase here, you essentially want to be a buyer of pullbacks here, at least the way I interpret it and would think about this market is dips here, and again, a dip might take a full 2 months or so in gold's case, especially on this time frame, but this is something where you'd want to probably be positioning with this dominant trend, which is emerging to the upside here. So gold, I like on future dips in the short term. Got to be cautious there, chasing that. You just have to know what you're playing for. But it does seem like we want to eventually sort of get back up and perhaps retest the 2011, 2012 levels over a long period of time, not certainly any time in the short term. Now, if we scroll down to silver, this has also made quite the breakout development here. And I love this chart because this is, again, really the power and reason why we look at these monthly time frames, is to really get a good sense of what's gone on here over a multi-year period. And essentially, silver has been hated and been in a bear market since 2011. I mean, it's been in this strong downtrend. It started in about 2015, 2016 to start to flatten out and go sideways. And again, we talked about this, steepness of downtrend that has been in place. We had a very steep stage 1, a slightly less aggressive stage 2, a more gradual stage 3, and that ultimately led to the breakout we saw 3 months ago. Heavy volume coming in. Looks like we want to get back up to the 20 area. Again, it's had a very quick move in very short order, so you'd have to know where your risk is and what you're looking for. But similar to gold here, I'd want to be positioning on any 5-10% dips here in silver. Makes sense to want to be playing for or accumulating for a longer term uptrend in that market. Now, if we get down to continuing commodities here, we look at oil. Oil here is getting kind of tight around this $55 area. It's been all over the place. It's had a couple of these very sharp moves, both to the upside and downside. And really, over the past 4 or 5 months now, it's been just kind of tightening up with a series of lower highs, slightly higher lows. And we're really kind of just waiting to see how this makes up its mind. It doesn't really have a strong longer term trend in place. It's mostly been sideways here since really breaking down in 2014 or so. So this really is something that I would look more on a swing basis. If you're interested there, I don't see too much on this long-term chart just yet. Of course, if it starts breaking above, say, $65 or below $50, then you have potentially those as upper and lower bounds. But until then, it just looks like a pretty, a pretty sideways market. Last but not least is natural gas. Natural gas has been really hit hard all of 2019. It has been consistently making new lows on the year, basically week after week, but it did start to turn around here over the past month and a half. It did bottom out almost down to about $2.05, $2.10 or so, but it did reverse course, and in fact, it did break above this accelerated trend line, which has been in place for basically all of 2019. So we are starting to see a little bit of a bounce here for natural gas. I mean, structurally, when we just look at this big picture here, it still is in a very tough spot. This is, absolutely more of a trader, shorter term, day-to-day, week-to-week market. We do have some momentum, which is moving to the upside here. Maybe we get as high as around 260 or so and start to retest this flat prior support area over the next month or two. But again, you still have to worry about a lot of this overhead supply and the fact fact that there's no real strong dominant long-term trend here. If anything, the long-term trend is to the downside or, at best sideways. So that's it. That's the last market. That's 16 different charts there that really kind of give a good picture of what's going on out there in the world and different asset classes. So hopefully this gives you some sense as to what's going on out there. And again, this is just helpful context when you're out there day to day and week to week trading to know what silver's doing on a bigger basis and the big breakout that just happened there, to not maybe get so pessimistic on the US equity markets when we start to look at things like the long-term picture and we see that, oh, this is really just been kind of consolidating here on this bigger picture, and this could turn into a beautiful kind of continuation pattern in hindsight, and you have breadth markets that are supporting and liquidity still flush and strong here to the upside as they lead to basically new highs and resiliency. So that's it for me. Again, you can, if you like these videos, they come out every other month or so. You can subscribe on our YouTube channel, follow us on the Trade Risk. Have a great rest of your day, and we'll talk to you in the next market recap video.